In the modern financial landscape, BlackRock, Vanguard, and State Street, collectively known as the Big Three, have amassed extraordinary power, reshaping the dynamics of shareholder influence and corporate governance. These asset management behemoths have become some of the largest stakeholders in nearly every major publicly traded company, owning approximately 20 to 25% of shares in the typical S&P 500 company. This unprecedented level of ownership gives them a monopolistic hold over corporate decision-making, with vast consequences for competition, market health, and economic vitality. The power grab, a modern monopoly on shareholder votes. BlackRock, Vanguard, and State Street have achieved a near monopoly on shareholder voting power, controlling a combined 25% or more of shareholder votes in the largest corporations in the United States. Their immense influence over the proxy voting process allows them to shape board elections, corporate policies, and long-term strategic decisions. Because these firms manage trillions of dollars in passive index funds, they concentrate voting power that would otherwise be spread among millions of individual investors. This centralization means that a small group of fund managers effectively controls the fate of corporate America, with limited accountability and little transparency. The way the Big Three exercise their power is often at odds with the principles of shareholder democracy. While they manage the investments of ordinary people, these firms prioritize their own corporate agendas and long-term strategic interests. The implications are massive. The same few firms can decide whether a company should pursue or reject mergers, shift its focus toward environmental initiatives, or overhaul its governance structures. The concentration of power has led to a situation where the Big Three, despite ostensibly serving the interests of everyday investors, operate as a de facto governing authority in the corporate world. The historical comparison: Standard Oil's monopoly. The monopolistic influence wielded by the Big Three draws inevitable comparisons to Standard Oil, the oil giant broken up by the U.S. Supreme Court in 1911. Standard Oil, under the leadership of John D. Rockefeller, dominated the oil industry, controlling production, refining, and distribution, and systematically eliminating competition. This led to calls for reform and, ultimately, the breakup of the company to restore market competition and innovation. Today, BlackRock, Vanguard, and State Street have similarly monopolized the flow of capital and decision-making across industries. The key difference is that while Standard Oil was one massive entity, the Big Three maintain a facade of separation. However, a closer inspection reveals that they are deeply interlinked, often owning shares in each other, and their voting patterns on corporate governance issues frequently align. This tight-knit structure allows them to exert outsized influence, much like a single entity with three heads, creating a modern oligopoly with the power to shape entire markets. Acting in tandem, a new kind of oligopoly. The relationship between BlackRock, Vanguard, and State Street is more than a simple case of parallel interests. They are accused of acting in tandem, with overlapping strategies that amplify their power even further. The Big Three own substantial stakes in each other, reinforcing a cycle of influence that leaves little room for truly independent decision-making. This implicit coordination has wide-reaching implications. They not only influence corporate governance but also drive market trends, from environmental and social governance, ESG, mandates to shareholder activism. This oligopolistic structure disrupts the competitive landscape of free market capitalism. When three powerful entities control such a significant portion of the market, innovation and efficiency suffer. For example, the Big Three's investment strategies have led to a phenomenon where underperforming companies, often referred to as zombie companies, are kept afloat, distorting market signals and siphoning capital away from more productive uses. By investing passively across indices, the Big Three support failing enterprises that would otherwise succumb to market forces, creating a less dynamic and innovative economy. Passive investing in the era of easy money. The rise of passive investing, spearheaded by the Big Three, has thrived in an era of low interest rates and abundant liquidity. During this period of easy money, capital flowed freely into index funds, providing a stable return on investment and encouraging the growth of companies regardless of their individual profitability. The passive investment model seemed to work because the environment favored a rising tide lifts all boats approach, in which even mediocre or inefficient companies could survive and even thrive. However, as we face the prospect of a secular bear market in bonds and a broader tightening of monetary policy, the cracks in this strategy are beginning to show. With interest rates on the rise, cheap capital is no longer guaranteed. The era of easy money is giving way to an environment where capital allocation will matter more, and companies will need to generate real returns to survive. The reliance on passive investing, which indiscriminately supports all companies in an index, is likely to falter as investors demand more strategic, active management that focuses on fundamentals and profitability. The bond bear market introduces a major threat to the Big Three's passive investment empire. As bond yields rise, the relative attractiveness of equities will be challenged, especially for companies that have relied on cheap debt to stay afloat. Zombie companies, which have been artificially propped up by easy credit and indiscriminate index investing, may finally meet their reckoning. The Big Three, which have contributed to the rise of these inefficient firms, could face significant losses, and the broader market could experience a painful but necessary correction. The concentration of power in the hands of Blackrock, Vangaurd, and State Street is a threat to both shareholder democracy and market health. By controlling a quarter or more of the shares in major public companies, they wield a level of influence that rivals the monopolistic power once held by Standard Oil. Their practices undermine free market principles, keeping zombie companies alive and distorting the proper allocation of resources. Moreover, the passive investing model that has fueled their rise may prove unsustainable in the coming era of higher interest rates and tighter monetary conditions.